So without any further ado, Gary Crabtree.
Thank you, Tim. Good morning. Everyone can hear me? Can everyone hear me okay? Okay, very good. I'm operating with a lavalier. I like to walk when I talk, so we'll get started here. It's been a couple of years since I presented. Obviously, COVID has kind of put the kibosh on things, so I'm trying to pick up from 2 years ago, and we'll go on and see what we have. Generally, when I make my presentations, I try to just throw a whole bunch of stuff together and let you make up your own mind as to where you think we're going, and then I'll tell you where I think we're going. Obviously, these are very interesting times, and so let's look at some metrics first that gives you an idea of the economy, not only locally but nationally, so that you could find out just about where we're headed. So let's take a look at the local economy, and this will give you some historical perspective of where we've been and possibly where we're going. As far as income trends are concerned, this goes back to 2011, so I try to go back about 10 years to give you some idea. The red line is the Bakersfield median family income. The gold line is California, and the blue line is the United States. So as you can see, California and the United States have pretty much paralleled one another. Bakersfield is always at the low end of the scale, but we've progressed from a median family income of about $45,000 in 2011 up to about $61,500 in 2021. Again, a lot of my data is not updated only because it takes time for this information to be filtered and posted, and it comes actually through some of the Federal Reserve banks. This one happens to come, the main statistical Fed bank in the United States is St. Louis. So the St. Louis Fed Bank is where we get our information. It's ironic that their information is slow being published. I don't know if they're trying to hide something or whether or not they just decided that they didn't have time to produce it. But anyway, as you can see, we've had a pretty good run in local income as far as median family income is concerned. This is going pretty fast here. Okay, here we go. Oh, it's double. Okay. Looking at our population trends, and this actually comes from information from the State of California Department of Finance. And they publish every year the population, 2021, Bakersfield MSA, which is basically Kern County, has a population of 908,000. And then it will break down where your population is going and where it's being originated from. In 2021, we, if you will notice, had a drop in births, and we had a dramatic increase in deaths. What was that from? COVID. So the net increase in natural increase in the county was 4,000 people in 2021. Then we look at migration and immigration, and then what we call net migration. So in 20 and 21, we had a total of roughly about 2,000, those are supposedly immigration coming from another country. So that's what we are reporting in the state. But obviously we know that a lot of those are not counted. So there's no way that we can really get you an accurate figure there. As far as our migration, we had almost 5,200 that have left what we call interstate migration. So we had about 5,200 people that have left the MSA to move to other parts of the state. The 7,000 or 7,500 in the last 2 years have left California, period. They're gone. So many of them, as you probably can figure, is moving to Arizona, Texas, Idaho, and I guess the latest new boom spot is Tennessee. Our birth to death ratio is higher than the state at 1.48 versus the state's 1.22. The birth to death rate ratio in both of these cases are unsustainable. In other words, we're going to shrink up, draw away, blow away if we don't have better birth to death ratios. The excess death rate for last year was 26.8%, which was because of COVID. Get this to work. Looking at employment trends in Bakersfield over the last 2 years, and again, we had some missing data because the state didn't produce in about 2 or 3 months. And this comes from the State Department of Finance. But the blue line represents the number of people that is entering or are in the labor force. So, you know, we started 2 years ago with about 195,000 in the labor force. 2 years later, we're about roughly 207,000 in the labor force that's at least looking for jobs. The green line presented the total employed. So 2 years ago, we had about 170,000 employed, and we're up to about 197,000 employed, causing the employment rate to drop from 13% down to about 5%. So things look good, but the real picture here is how many people are in the labor force and are actually looking for jobs. Many people have dropped out, not looking for jobs because it was easier for them to stay home and get paid by the government. So in our employment trends, we look over the last year, Bakersfield proper, and I broke those down from Bakersfield and then the rest of the county. So Bakersfield added about 700 to the labor participation rate. They added about 1,200 to the employment for our unemployment rate of 5.2%. The rest of the county, we actually lost 700 in labor participation, added 900 jobs for a 7.2% unemployment rate for the rest of the county. Things are looking good. Well, California is at 3.7. United States is at 3.3. Again, I truly believe those numbers are phony, especially on the US level. So you think, well, we're not in too bad a shape employment-wise. Well, compare Kern County with the rest of the state. We're the third worst in the state in unemployment. Only in front of Imperial County, which is mainly an agricultural county in the southern part of the state in the Imperial Valley, who has a current unemployment rate of 16%. Tulare, which is right up the road from us, again, Central Valley, agricultural based. They are just a little bit above us at 7.5%. The rest of the counties in the state are enjoying a much better employment rate than we are. So if we look at some of the employment trends that we have, this is over the last month compared to the same period last year. Farming lost 200 jobs, but over the last year picked up 3,600. Petroleum actually is holding at about 7,300 jobs. We've lost 100 over the last year. And, you know, obviously, depending upon what happens with the new leases and so on and so forth, we could either go up or down. But to put that into perspective, petroleum at its height had an employment force employed of over 14,500. So we're at about 50% level in petroleum. Construction, for this year at least, is holding its own. We're about the same as we have been in the past in the good days. Retail trade is starting to show a little bit of weakness. Professional services, the same thing. Education and health, we're up 400 over the month and 2,000 for the year. Leisure and hospitality is now starting to show weakness. Leisure and hospitality are restaurants, bars, food services, and everything else. So I would imagine if you're like me, you probably don't go out to dinner as much as you would like to anymore. I can't believe I spent $22 for 2 hamburgers the other day. So leisure and hospitality, you'd probably see as we move further into this recession, and it is a recession, we're going to probably see more weakness in leisure and hospitality. And of course, good old government, they're always there for us. 2,200 jobs last month, 2,100 over the year. So basically, as it stands, last month, we gained about 1,500 jobs, 10,000 year over year. Looking at our gross domestic product, and again, this goes to 2020. Again, St. Louis Fed is not getting themselves up to snuff. This is measuring Kern County's gross domestic product. So that tells us what our output in terms of value of of what we're putting out in goods and services. Over the years, we've kind of gone up and down, but in 2019, our GDP was $47.5 billion, and in 2020, that dropped to $45 billion. Obviously, what we can't see in 2021 is the fallout from COVID, but also what we don't know has transpired with respect to oil or agriculture. We obviously know that we have taken some acreage out of planting, so that's going to hurt our domestic product there. And of course, oil is just chugging along, using what they can to recover, and basically in a maintenance mode until something changes with our energy program, which may take a while. I bring this slide up only to show you how much oil counts for Kern County. This is from the Kern County Tax Assessor, and every year when they do the rolls, they break out oil and gas assessments. In other words, oil and gas, for example, the assessed value of oil and gas was about almost $32 billion in 2012. That was 10 years ago. 2021, we're down to 11 billion. So it's down. So to give you some idea, and this is why the county of Kern needs the sales tax, because this is a big part. I can give you an example that in 2009, at the base of the housing bubble, the rest of the state, because they didn't have oil, lost assessed value like crazy. And the assessed value on real estate, homes, commercial, what have you, actually dropped $29 billion. But in 2009, that $29 billion in assessed value was recaptured by our oil assessments. So we lost nothing during the housing bubble. Housing went down, oil assessments went up. We were one of the only counties in the state to have stable tax revenues during that period of time. So at our height, the total assessed value of oil and gas in our Kern County rolls comprised 35% of our total tax roll was attributable to oil and gas. Today, it's 11%. So that's why the county needs a sales tax, to be honest. Interest rates, I can't keep this chart up to date fast enough. But over the interest rates, and this again is the Freddie Mac published interest rates on a monthly basis. The blue line represents 5-year ARM, and the green, a 30-year fixed. So you can obviously see that, and if we look at, say, the previous administration, we had interest rates right around 3.5% to 4%. They started going back down. And when the new administration took office, we had 30-year fixed right at about 2.75%. Since then, sky's the limit. 6.7, and I just got yesterday's release on Fannie Mae or Freddie Mac 30-year fixed 7.02. And as I was writing this, I happened to get a news flash on my computer. Fed just raised it another 0.75 of a point, 75 basis points. So we know what's going to happen here. We know rates are going up. One of the things, and this is probably for some of the newer people, the older people know about this anyway, but I would like to just give you a demonstration and show you how to look at future interest rates and what's going to happen with them, because pretty much mortgage rates are tied to the 10-year security, 10-year Fed security. So I'm just going to superimpose this over. You can see what the chart looks like. There's the 10-year Treasury yield, and as you can see, it almost mirrors the 30-year fixed rate. So your key to looking at future interest rates is based on the 10-year Treasury. So let's kind of go over a kind of a recap of the 2021 market. Median households income increased by about 4.3%. 2021, the inflation rate currently is 8.2%. So we have a negative 3.9 loss to the family. Population birth rate, as we reported, is down. Death rate is up due to COVID. And 5,500 people have left the community in the last 2 years. Immigration is again down about 1,000, but again, I have to at least put the caveat in here. That isn't the people that we can't count those people that are here. And we know they're here, obviously, and they're part of our community. Labor participation rate went up 3.5%, employment up 6.7%, so the unemployment rate went down about 2%, 2.2%. Oil and gas assessments, as we said, declined 64% since its high in 2014. The current GDP declined about 5% from 2019 to 2020. We won't get the 2021 numbers until December. In the past year, due to the interest rates, the monthly payment on a median price single-family home in Bakersfield has increased 45%, while the income to qualify increased 33%. So over 30 years, the buyer is going to pay an additional $200,000 in interest during that period of time, just because of the interest rate, and that doesn't include the 75 basis points that it'll probably go up here within the next month. So that number becomes larger. So let's look at our market trends that we have here. Looking at a quarterly comparison, and this is comparing the last quarter ending in September with the previous quarter and then the same quarter last year. As you can see, our listings are growing at a very slow pace at 895. So, but again, listings are up about 80% year over year on a quarterly basis. Again, to put that into perspective, we're still basically in a shortage. We still don't have enough homes on the market to sell. In Bakersfield, the city of our size, we should be running somewhere between 15 to 2,000 listings on the market at one time. So again, we still have basically a shortage. Our closed sales, as you noticed in the last quarter, declined 10%, 18% year over year. Our unsold inventory is climbing. We're at 1.7, almost 2 months. Again, to put that in perspective, at the height of the market and everything, our unsold inventory was less than a half a month. The existing median price it started the year, or I'm sorry, in 2021, we had 335,000. It jumped in the second quarter to 385. That was the peak of the market, the prime marketing season. And in the last quarter, it's now declined another 15,000. So we've got a 10% increase in median price year over year on a quarterly basis, but a 4% decline in the last 3 months. Our list to sales price ratios are now dropping like a rock. There was times where the average list to sales price ratio on a monthly basis was 102, 103%. Multiple offers, bidding, you know the story. So now that is dropped to 99, and when I looked at the monthly numbers, it's down to 97.6 now. So we know the market is softening. Price per square foot, again, still reflects about the existing median price, 10% up year over year, 3% down over the last quarter. Our REOs, which are real estate owned foreclosures, are still doing fine. But I'm waiting for the other shoe to drop. There's a lot of reasons why, obviously, but there was many homes 6 million in the country that were put under loan forbearance. Those people haven't been making payments now for 2 to 3 years. And once they turn the spigot off and they start having to make payments again, many of these people don't have the money to do so, so they'll go to foreclosure. So we're obviously expecting that our foreclosure rate is going to go up. And so all of those who are not familiar with selling REO property, I would suggest you familiarize yourself with it. There was a couple of 3 agents in town that really did very well during 2009 when the housing market crashed. Lori McCarty comes to mind. But still, it's a special market and you got to know what you're doing. A lot of people, you won't have the stomach for it because you got to deal with these lenders. A lot of times after the lender foreclosed, they assign you the listing. They expect to feel that you fix the property up out of your own pocket and then apply for reimbursement, which is going to be very slow in coming. So you better have some deep pockets and some liquidity out there if you're planning on entering the REO sales market. Median days on market, as you can see, is going up just from 7 to 19 days. That's still not bad, but it's still showing a trend. On the monthly comparison, we have a little bit more data. Again, listings are going up almost 82% year over year. Our closed sales are now going down 18% last month. The new construction closed sales are down a little, but up quite a bit over the same period last year because the builders have been going pretty crazy over the last year in putting out new product. I expect that's going to slow. As interest rates goes up, there's going to be less and less people being able to afford new construction. It will not surprise me to see builders start offering 3-2-1 buy downs. If you don't know what that is, then you're a lot younger than I am. So we have, I think, that kind of to look forward to. And we had a pretty significant drop in the existing new construction price last month, almost, in this case, about $25,000 and a 5.4% drop in new construction median price. Looking over the active listing prices, you can see that the listing prices now are starting to drop. Here's kind of an anomaly. And whoops. We gotta get this to work here. I guess not. Okay. I had highlighted this and it didn't take on my presentation. The existing median price last month was $385, up $10,000. I don't have an explanation for it, but all I can say is that when we look at existing pending prices, that kind of gives us a mirror into the future of what's going to happen going forward in a short-term basis. So I would not expect to see that we have about some kind of an increase next month in closed median price. Price per square foot, again, starting down. New listings are pretty hard to come by, and again, we dropped 34% month over month and just about 7% year over year. So the houses are not coming on the market. So we don't have product to sell. Median days a year ago was 8, now it's 25. The annualized appreciation rate was something that I just came up with to get some idea of where we are going on an annualized basis, which is comparing the average sales price for the previous median price for the last 12 months versus the current 12 months. And of course, we are now starting to see that this is now dropping for the first time. Housing affordability index, again, because of interest rates, has really gone down significantly. A year ago, our housing affordability index was 45%. What that means is that 45% of our population of house buyer could afford a median priced home a year ago. Now it's down to 32%. So we're squeezing that market down. Now, the good news is that the state is 16%. So we're double the state. Looking at a 4-year comparison of our prices, just to give you some idea of what kind of a trends we've had, the blue line is 2019. We started the year 243,750, ended up at 264. So we can see that in 2019 was about when we started things started happening. And then in 2020, we started at 252, ended at 297.5. In 2021, we started at 302, ended at 350. And year to date, we have been, for all intent and purposes, virtually flat. The first 3 months was 370,000, spiked to 390,000 in April, which is the beginning of the peak marketing season. That's when people were coming out of the closet, ready to buy. And then, as you can see, it's trickled down to where we are at 365 or 5,000 below where we started the beginning of the year. So this pretty much kind of gives you an idea of the trend of our market and where we're going. Looking at it on a median sales price over the last 2 years, the blue line represents average sales price or mean, and the green represents median. So you can see that we have enjoyed a rather steady increase over 2021. And then starting well, actually that's September 21. And then in January, we had this peak actually up here. And then in April, we started down. So looking forward in the future, it probably will continue to decline. This is just the annualized appreciation rate over the last 2 years. 2 years ago, we were only at 7.3. A year ago, we were at 15. It peaked at about 19, and now it's on its way back down. This is a goofy chart, and I don't even want to try to explain it, but it's sales volume. I was trying to illustrate just exactly what our sales volume looks like over a 4-year period, and the point simply is that you can see that the beginning of the year is always slow. We peak in the peak marketing season in June and July. And August, everybody wants their loans closed by the end of August, obviously, and when their kids in school, they want to make the move. So in looking at 2019, which is the blue, you can see the trend line as it starts the year, goes up, peaks in June and July, and then heads back down to the end of the year. And we really look at the off-peak season starting in about September and October. Usually in October through December, market activity slows, and that's just a normal phenomenon. People don't want to sell their house during the holidays. They don't want buyers traipsing back and forth when they're through Thanksgiving and Christmas and what have you. So that's just a natural phenomenon. Then we look at 2021, which is here. We started out 2020. We started low, we built, and we kept climbing all that year. So where in December, we hit a record of 707 closings. Starting in 2021, we had 512. So that's a carryover from this down to here. And as you can see, again, we peaked and then it tapered off at the end of the year to 571. So far this year, which is the gold bars 2022, we started at 438. It built, leveled out, and is now on its way down. So you can see just by historical data what the trend is showing you. 2021, we had, this is year to date. 2021, we had 5,512 closings. 2022, 4,618 closings. So our sales volume year to date is down 16%. New construction, again, this shows a price versus volume. Red is the volume, blue is the price over the last 2 years. So you can see how new construction has steadily climbed until it reached its peak in April of this year, the peak marketing season, and now it's on its way back down. So the new construction median price is pretty much following along with the existing price. Builders are going to be pretty hard pressed going forward as long as the cost of materials continue to rise. Construction is going to slow because a lot of builders can't get materials to build. You know, we do have a major supply source. It's called China. And many of the housing components, plumbing fixtures, you name it, just open an appliance and it'll say made in China. So a lot of those materials that we use to build our houses are probably sitting in a freighter someplace off the Pacific coast. So that's slowed down some construction, but the costs of production have gone up. My friend Hal Aaron, who's been in the lumber business for eons, can probably tell you that, you know, how, what was a 2x4 a year ago versus a 2x4 today? About 43%. And yeah. And so what we're saying is that we use a lot of 2x4s to build houses. So you can see where we're at. The other thing that I should mention about new construction is the fact that with the advent of Prop 13, municipalities have turned to impact fees, which are cutting into development tremendously. It's no longer just a building permit. You have a park fee. You have a transportation fee. You have a school fee. One school district is now at $8 a square foot. And all the other impact fees that are added onto it on an 1,800 square foot house today, just to pull the permits and pay the impact fees is about $38,000. So that's got to be passed on to the consumer. Oh, yeah, this is interesting. I was going through my slides yesterday. The last I presented was in November this year, 2 years ago in 2020. And so I was looking at my forecast and what I had forecast for the coming year in 2021. And so this happened to be in November the 10th, I think it was. It was about 2 or 3 days after the election. So we knew we had a new administration coming in. So this is what I forecast 2 years ago. Tax increases would cause consumer prices to rise and net disposable income to decline. Impacts on home demand and prices. I think that came true. The only difference is when I was thinking of tax increases, I wasn't thinking of all the stimulus bills that were shoved into the economy and cheapened our dollar, but that's still a tax increase, any way you look at it. Move to renewable energy is going to have a negative impact upon our economy. Would anyone like to disagree with that forecast? Increased regulations will cause an increase in cost, especially in business. FHA policies and regulations will increase the cost of doing business, which they have. And finally, I forecast that birth rates were going to decline and death rates were going to increase. Of course, I had the benefit knowing in November of 2020 that we were in the midst of COVID, and that's why I forecast that. So looking at a 2022 summary and looking at the market and how it's done this year, quarter one, we had a pretty strong increase quarter over quarter of about 7%. Our median price at the end of the first quarter increased to almost $370,000, but we had a 37% decrease in volume. In the second quarter, we continued to increase at about 4.1%. We hit our high of the year at $385,000. I take that back. We did have 1 month at $390,000, and we had a 14% increase in volume. So this is second quarter, prime marketing season. That's when everybody is buying and selling. In the third quarter, we had a rapid change with a 3.9% decrease in price to $370,000, and we had a 10% decrease in volume. You can see where we're going, folks. Over the last year, the 30-year fixed rate increased from 3.1 to 7.08, and inflation is pegged at 8.2, which I don't believe. I think it's actually higher than that. Nevada is reporting their inflation rate at 16%. California, I think our inflation rate is higher than 8%. And I don't have to tell you that. You shop and you fill your tanks with gas on a regular basis. So buyers are being priced out of the market because of this. Housing affordability, as I said, has declined 13% to 32%, meaning we have less qualified buyers out there to be able to afford a median family house. Good news is the state's 16%. So we're twice as good as the state. Marketing times have increased from 8 to 25 days. Active listings have increased. Active listings on the market have now increased to a median of 44 days. So we know that active listings are staying on the market longer. We don't have the buyers. I did a house, very rarely. I did a house the other day in the Northwest out in River Lakes, in the River Lakes Ranch area. 1,400 square feet. I had 9 comparable sales from January to July, and all of them were in the 365 to 370 price range. There's one listing on the market of the same type of house, same size, same physical characteristics. It's been on the market now for 62 days. They started at 370. they're down to 350 and they still don't have any showings. List to sales price ratio is declined 3.4%. That's just another indication that our market is softening. I mean, we've enjoyed some really good times with COVID, with people moving in to Bakersfield, being able to commute, and that's still probably not going to go away. But we've had some, obviously, multiple offers, bids that has driven the list to sales price ratio up into the 103, 104% range. And now, as I said, last month that was down in roughly 98%. So we've had a decline in the list to sales price ratio, which again is a clue to you that the market is softening. So again, with respect to home buyers coming from outside of Bakersfield or outside, they have come from the Los Angeles basin, even San Francisco, Sacramento, in-state, because they know that the Central Valley is the most affordable. And so they're trying to take advantage of the fact that they are able to telecommute and work from home. It makes it much better for them. They're moving into a community that has a lower cost of living, lower cost of housing. And so they're pretty happy campers. Unfortunately, big tech and the companies that they work for have been keeping tabs on their telecommuters. And they find that the telecommuter is less productive working from home than they are in the office. So, is that any surprise when anybody can walk out, walk into their bedroom in their pajamas and work all day? Isn't that great? So there are companies now that are saying, okay, we know we want production out of you. We need it from you in our office, not at our home. Since you're less productive at home, we are lowering your salary 15%. So these people are being offered a choice: move back to the office and keep their salary, or give up 15% of their salary and stay where they're at. The vast majority are staying where they're at. Thank God, because that's Bakersfield. The market share, and this kind of gives you a perspective of what your target markets are. 300,000 to 400,000 has the largest market share. This is over the last year, so this is from January 1st at 33%. So 1 out of every 3 buyers are in that 300,000 to 400,000 range. Above and below, which would be under 300 or over 400 up to 700, has 23% market share each. So it's evenly divided. Above 700,000, your market share is only 2%. I kind of call that the Mary Christensen territory. And again, there's still some houses out there that is selling above $1 million, but I've noticed a significant drop in the prices. I've also noticed that on sales above $1 million, where our normal list to sales price ratio is about 98%, the normal list to sales price ratio above $1 million is 88%. So, for what it's worth, obviously this doesn't take much to understand that our entry level and first time home buyers are going to be the hardest hit. But yet again, still that sub 300,000 range appears to be a very strong market, because that's all they can afford. And so I'm seeing more strength under 300 than I am in any of the other markets. Lack of affordability, the investors we're now starting to see move back to capture some of these properties and turn them into rentals. Why not? The rents are going through the roof, and they make them economically feasible for them to come back and re-rent out. I appraised a 892 square foot, 2-bedroom, 1-bath home on E Street in Westchester. It had been fixed up, been rehabbed and everything else. 892 square feet, sold for $300,000. Owner of the property has a 1-year lease for $2,000 a month. Think about it. 900 square feet for $2,000 a month. I mean, that's $2 and something a square foot. It's, you know, and for years we always used to figure single families would rent about 85 cents a square foot. We're up to $125, $35, $40 a square foot for rent now. With the high rates, I'm expecting that we're going to encounter some of that creative financing as we go through. AITDs, silent seconds, and it's going to be necessary because these people are going to be motivated. They have to sell their house, and the people are not going to be able to afford a new loan. So here we go with the AITDs again, back to the Jimmy Carter era of prime rate of 18%. And if you don't think that wasn't a nightmare for appraisers, we actually found that the buyer was not buying real property. They were buying financing. And they could go out, buy the house, get a loan for 16%, or they can come in and do an AITD with the existing borrower at 10%. What are they going to do? They're buying financing. And it was very, very hard to value property in those days because you didn't know how much of it was still real property, how much of it was part of the financing. Good example of that is Campus Park. At that time, Campus Park, the first part of Campus Park was just being developed. We had 2 home builders in there, Coleman and US Home. Coleman stuck with the rates. I think at the time they were at 13.5%. They sold their homes around $90,000. US Home built a much inferior product. Okay. They sold their homes for $90,000 also, but they offered all their buyers a 3-2-1 buy down. So they were qualifying their buyers at a 3% lower interest rate than Coleman was. And they were able to sell out the tract. So what happens fast forward 3 years after the rate went on up to where it's now back to 13 or 14%? Almost every one of those US homes foreclosed. And what did they sell for when they got them out of foreclosure? Coleman was still selling at 90 to 95,000. All the US homes sold at 70,000. So there's the 3-2-1 buy down in effect as far as the market is concerned. With no change in economic policies, I think the market's going to stagnate into 2024. We just don't have anything that's going to move this market. My forecast for 2023, again, pouring over everything that I have. This is my forecasting model in December of 2020, showing the December of 21. This shows December of 22, December of 23 here. So what I am forecasting is about an 8 to 9% decline in median price over the next year. It's not too bad. Not too bad, considering that from 2005 to 2009, we lost 60% of our value. In 2005, the median price peaked in June at $390,000. In April of 2009, our median price was $115,000. So talk about a catastrophe. But I think that we're in a position where we are going to see a correction, but I don't think it's going to be as severe as we expect it to be. There's my information if you wish to copy it down. My Crabtree report that I used to issue on a subscription basis, I have now discontinued. Basically, it became economically infeasible for me to produce the report on a monthly basis. My subscribers, I was charging $350 a year, and my subscribers started dropping off. To me, it was presented about a $15,000 a year income. It went to zero for the most part. I found that many of the people who were subscribing to my report were copying it and passing it along to others. So my report got diluted. I didn't have the income. So I discontinued the full report. I do an executive summary every month. It's basic numbers and some analysis, some observations. It's free to you if you wish to just send me an email, telling me to add you to the list, and I'll be happy to do so. I have to do the research to keep up with my business, so I might as well share it with you. So if you would like a copy of the report, send me an email with your email address and I'll put you on the list. I also will report on the narrative portion of that report on Facebook, on my Facebook page once a month. So if you just want to friend me on Facebook, you'll get that information there. We're almost out of time. So
Are there
I'll take a
questions
few
for Gary?
questions. Yes.
Gary, I had a question on your REO stat. Being that they're going to increase, did you take into consideration the fact that even the ones on forbearance, they've had a fairly large increase in equity, and what effect that would have on whether they just would sell rather than go into foreclosure?
Yeah. And the information I gave you on the 6 million actually came from the National Association of Realtors. What they're saying is they have examined that and examined the equity positions and believe that there are 6 million homes at risk. Yes.
For 2024?
Well, obviously, to me, the biggest problem that we're going to have is we have to get some change in policy. Now, that change may come next week, or we don't know. This same thing happened to the Clinton administration, and he changed course in midstream and the economy started to recover because he listened and he was able to negotiate. I don't see any points of negotiation with the current administration when it comes to economic policy, especially when they are at a point where they're stubborn about their green energy, and yet we're sitting here with all the energy we need right underneath our feet, especially in Kern County. So it's going to be dependent upon the policies and that what happens after next Tuesday.
Thank you for that answer. I guess I wasn't very clear. On the REOs, do you expect them to ramp up in 2023 or more like 2024?
The REOs are probably, depends on when the spigot gets fully turned off with the forbearance, because they've been delaying that. They were supposed to turn off that forbearance a year ago. It's still going on. So as soon as that gets turned on, that's when the short order, you're going to see your REOs start to increase and decline. I track every month foreclosure rates in Kern County. I have a good working relationship with the Kern County assessor, especially our new assessor, Laurel Avila, who, if you don't know, is Jeannie's daughter. But she sends me all of notices of default, cancellations of notice of default, notices of trustee sale, and actual trustee sales on a very monthly basis, and I've got that tracked back 15 years. Right now, what we're seeing is a small increase in foreclosure starts, but nothing that is alarming. So I say the status will be quo until that forbearance tap is turned off. Anything else?
Any more questions for Gary? Jamie, is there anybody on Zoom that wants to pose a question?
Okay. Well, thank you for allowing me to be part of your meeting today.